morning, everybody, and welcome to our webinar on the effects of IFRS 9, 15, and 16, the triple threat accounting standards, on business combinations. And also, we've added a new part to this month's webinar, and that is accounting for COVID-19 related rent concessions. It's an area that is developing very rapidly, and therefore we thought we want to give you an update. Now, as always, I'm joined by my partner in Sydney, Kevin Frobus. Good morning, Kevin.
Good morning, Aletta. How are you today?
Yeah, I'm well. It's freezing in Melbourne, but otherwise I'm well. I hope you and all our attendees are well too.
Hello to everybody on the webinar.
All right, so as I said earlier, we've divided, originally the title was supposed to be just effects of IFRS 9, 15 and 16 on business combinations. However, due to all the discussions we're currently having with so many of our clients and also the rapid changes, we thought we'll also talk about accounting for COVID-19 related rent concessions to make sure that all of you have all the very latest information. So basically, Kevin will be looking after part A, and then I'll be looking after part B. I just wanted to remind you that around COVID-19, we have a lot of resources available on our BDO website, and it's available free of charge. So on our website, at that link at the bottom of the page, there's a lot of international financial reporting bulletins. We've recently added one on impairment testing, and we are working on one with illustrative examples around accounting for rent concessions. But if you want additional information, please look there. And then also, if you would like to join us for our virtual IFRS masterclasses, I actually presented the first one yesterday. It was a masterclass from 8:30 to 1 around all the COVID-19 impacts on 30 June 2020 financial statements. And it's all case study based, so please register for those. We're also wrapping up our series of masterclasses on IFRS 16. I think there's another few over the next few weeks. Kevin is still doing one. I'm still doing another one. So you can register for those AASB 16 masterclasses or COVID-19 masterclasses. And then, of course, if you're looking for a technology solution, please contact us about BDO Lead, our SaaS solution, or if you want to outsource your lease accounting to us, please contact us. Now, at this stage, I would like to hand over to Kevin to talk about the effects of the triple threat accounting standards on business combination. So, Kevin, it's all yours.
Thank you very much, Aletta. And yes, this is a really interesting topic which has reared its head again on a number of engagements that I've been working on. And I must say that if you're going to be involved in an acquisition, or if you are acquiring a business in a business combination, so that's IFRS 3, this can have enormous impacts not only on the accounting but also on the valuation of the purchase price allocation. And some of the problems we've run into recently are when a purchase price allocation is done and an external valuation is performed, where you essentially value all the assets on acquisition. The impact of IFRS 15, 9, and 16 on the purchase price allocation hasn't necessarily been taken into account in that purchase price allocation, which means you get the values of the assets wrong, and then obviously the value that flows to the goodwill as well. And it's something that can't be undone after the fact. So if you've engaged a valuer to do a valuation or purchase price allocation under a business combination, and they haven't taken into account the impacts of IFRS 15, IFRS 9, and IFRS 16, that valuation starts to lose value by the time you actually get to the accounting, because you in some cases double count assets in the valuation, or you undercount assets in the valuation, and sometimes you get the goodwill number wrong in that valuation. So it's really important, I think, today, the message that I'd like to get across is these concepts that I'm talking about aren't only accounting related. They actually push all the way through to the purchase price allocation and the valuation by the valuer of the individual assets acquired. And I'll show you what I mean as I go along. The first slide which I've got here is just to remind us about what these triple thread accounting standards are. And they are the standards IFRS 9, IFRS 15, and IFRS 16. Now, I've been using this slide for probably about 3 years, and I'm going to give myself a pat on the back and be a bit egotistic and say that I never actually understood what I was doing when I put it together, but it turned out to be so right at the start about how they interlock with each other, these three standards. These three standards are interlocking, and that means they're all contract-based. So revenue contract, leasing contract, financial instruments, you can all see that based on the definitions, they're all contract-based. Revenue contracts even have the word contracts in the title. IFRS is a contract between parties about the right to use, and IFRS 9 is financial instruments, about a contract that gives rise to assets and receivables and so forth. The big thing with these is that you move between them. That's where the interlocking comes. So when you sell goods to a customer, you start with a revenue contract and you have credit revenue. The debit side sits in the financial instruments standard either as a receivable or as cash. When the receivable is paid, then you'll be working in the IFRS 9 standard because the cash will be received. Now, the interesting thing here is that when you have a business combination on top of these, what happens is that from the point of view of the acquirer, they are in a different space in the interlocking standard to where the acquiree is sitting. And that's the real problem that you need to consider. Because, for example, and we'll see some as we go along, the acquiree might be accounting for a revenue contract in IFRS 15, but at the time of the business combination, the acquirer may see that as an acquisition of a financial instrument contract because the acquirer hasn't got any obligation, let's say, to actually perform under the revenue contract, and from their perspective, they might just be acquiring a stream of cash flows. That's the example I'm going to use later on. This is becoming a critical problem in acquisition accounting because the acquirer often finds itself looking at the acquiree at a different place in the interlocking loop that I've got on the screen. They're in a different place. And I'll show you what I mean as I go. So I actually don't think I've ever seen a concept more critical to accounting and valuations as this concept. If we jump to the next slide, this is just remembering where we came from, and I'm going to use the revenue standard as an example. Just remember that from the revenue standard, we moved from an old standard that used to be transaction based and income statement focused, like matching of revenue and cost. We moved to a revenue standard that is contract based, which talks about transferring revenue and service obligations and goods and services on a control model. But more importantly, under the revenue standard, you can now have a variety of contract assets and contract liabilities appear on your balance sheet. And it's those contract assets and liabilities that become impacted by the business combination standard. Because when an acquirer acquires a business and that business has contract assets and contract liabilities on its balance sheet, it's those contract assets and liabilities that have to be fair valued on the acquisition of the business combination. And so valuing a contract asset or a contract liability that sits on the balance sheet of the acquiree at fair value immediately gives you a difference between the way the acquiree accounts for it and the acquirer accounts for it. So moving on to the next slide then, Aletta, if you may. This is just remembering where we came from. The whole concept of these three standards is that the entity has rights and obligations that are based from a contract or arrive from a contract, and those rights and obligations and those assets and liabilities, they need to be fair valued and considered on acquisition in the business combination, and that's what gives us this little problem. I've also put their IFRS 9 and IFRS 16 on that slide, and you can see they're all contract based. So when we have a look at let's say the financial instrument standard on the left-hand side of the slide, there you have financial rights and obligations, and those are on the balance of the acquiree. On acquisition of a business combination, those need to be fair valued at acquisition date. And the same with the leasing standard on the right-hand side. This is where you have the right of use asset and the lease liability obligations if there's a lessee arrangement. And the same thing here. If an acquirer acquires a business and that business has a right of use asset on their balance sheet, that right of use asset must be fair valued on the date of the acquisition of the business combination, which means that it will be somewhat different to the acquirer's books. So the subsidiary or the holding company might have, in a business combination, might end up having different accounting and different outcomes. Now, all of that sounds wonderful. It's actually just there's so much going on there. So the only way to really do this is to show you an example of what I mean. And I actually spent a bit of time putting this together last night, and I realized that there's so many variations. So I decided to put two scenarios together to show you some of the complexity that the entities can face when they're doing business combination accounting, and also the valuers should be thinking about when they're doing purchase price allocations. So let's just remember that IFRS 3 talks about a business combination being the acquisition of a business. You're acquiring the rights and obligations of the business at an acquisition date. And IFRS 3 requires that the assets and liabilities acquired of the business on acquisition date should be measured at fair value on acquisition. So if I apply that to the leasing standard, because that's the topic of the moment, now remember the acquiree or any entity that it's being acquired, they will be, let's say, applying the new leasing standard. And let's assume that they've got a lease on their balance sheet. So they'll have a right of use asset on their balance sheet, and they'll have a lease liability on their balance sheet. They'll be applying IFRS C, a leasing standard. So I kind of thought last night, well, there's maybe two scenarios I could think of. So the very first scenario, Aleti, if you could swap the slide there, please. The very first scenario I was thinking about is, what if I come along and I'm acquiring a business, and that business has not applied IFRS 16? So in other words, they are still on an old operating rental model. So here I come, and the top line is the acquirer, and the bottom line is the acquiree. And the top line acquirer, they must acquire this business. There's a right of use asset that exists because under the IFRS 16 lease accounting standard, when you have a business combination, you've acquired an asset and a liability, there might be a right of use asset there, you must bring it on at fair value if you are the acquirer. But perhaps the books or the accounting records of the acquiree, they don't have any IFRS 16 accounting. They're still using the old operating rental model. Maybe it's because they haven't transitioned to the new standard yet. So then they actually do transition to the standard at a later date, and then they apply the financial liability model. And you can see here that there's essentially two accounting records emerging. The top line would be the acquirer's accounting. They would acquire the business, and they would have to bring a right of use asset and a lease liability or financial liability on at fair value on the acquisition date, and they would account for that lease based on the original fair value after acquisition. But the actual acquiree, let's say a subsidiary, they would have been under an operating rental model before they transitioned to the new leasing standard. Then they transitioned to the leasing standard, and then off they go under the new leasing standard on a separate tangent. So you can see the multiple possible problems here. The problem with that is that if you are doing a business combination, a purchase price allocation, and you've acquired an entity that has a lease but hasn't yet transitioned to the new leasing standard, they won't have any asset or liability on their balance sheet for the right of use asset. But the acquirer will have to bring that on as a right of use asset in their purchase price allocation. And that, first of all, means it's got to be done at a fair value basis. Now, I'll get to what that means in a moment, but it also means it's going to impact the allocation of goodwill and under the purchase price allocation. So you can see the complexities emerging. It can be quite an onerous task. And if the valuer who's doing the purchase price allocation has not taken the right of use asset and financial liability into account in the purchase price allocation, then your goodwill number when you do your purchase price allocation is going to be incorrect. If we move to scenario 2, this is just another extreme scenario of what can happen, and we have seen happen in practice. Under scenario 2, I'll just wait for you to move. There we go. This is probably more common now in terms of where we are in terms of transitioning to the new standards. Yeah, you have an acquirer at the bottom who has transitioned to the new lease accounting standard. They already got a right of use asset on their balance sheet, and now we have an IFRS 3 acquisition, a business combination above that, where the acquirer acquires the business. And once again, you've got to look at that right of use asset, and you actually have to decide whether the right of use asset in the acquiree's books, is at fair value, and does there need to be an adjustment on acquisition up to fair value going forward. So that's just one example and another scenario of the sorts of implications you can have under this standard. So if we then take that to the next level, and we look at actual leases, what's the actual requirement for business combinations and lease accounting? Well, the first thing is that the acquirer shall measure the lease liability at the present value of the remaining lease payments, as if the acquired lease was a new lease. And this is important because from the acquirer's point of view, they're acquiring an entity that has a lease, that's on their balance sheet as a lease, but from the acquirer's point of view, it's a brand new acquisition on that date. It's part of the purchase price allocation. So they've essentially got to bring the asset onto their balance sheet as if they were acquiring that lease at that date. So the standard actually deals with this, because you can see on the next red block on that stand, what the acquirer needs to do is they bring the right of use asset on at the same amount of the lease liability, adjusted to reflect favorable or unfavorable terms of the lease compared to market. And that's because the acquirer is acquiring a new lease on the date of acquisition. Even though it already exists at the level of the acquiree, the acquirer has to actually bring that on at favorable, unfavorable adjusted terms. And more importantly, the lease liability discount rate is going to change, because the discount rate used to measure the lease liability is going to have a different risk profile to the acquirer than it would have had when the actual business that was being acquired, when they actually started doing lease accounting. So you can see the interchanging problems that arise here. The short answer to this is, if a business that's been acquired has a lease liability and a right of use asset on the balance sheet, the question you have to ask is whether the numbers that are in the books of the business being acquired are appropriate to be used in the purchase price allocation when you're doing the business combination accounting, or whether there are adjustments that are needed for fair value or market value changes. That's the real question. And you must do that before you get to your goodwill or so forth, because otherwise you're going to get a different answer. Aletta, I think I'm exhausted already just from the introduction. So we go to the discount rate here, and this is just a little diagram that we've put together. Now this is available. I actually took this straight from BDO's accounting newsletters, which Aletta and the team at the national level work so hard to put together every month. So we have actually dealt with this over a series of articles in our accounting news segment, which we have links to that at the end of today's presentation. So all these slides and some examples are actually available. But really with the lease liability, the big issue on acquisition is whether you have to change the discount rate. So the discount rate, or the incremental borrowing rate that you need for your discounting under your lease, is really dependent on whether you're acquiring a separate legal entity as part of the acquisition, or whether you're acquiring the business assets straight out and into the books of the acquirer. And I won't get too much into the detail there, other than to say the discount rate is all important, and it's all based on how the deal is structured, how the acquisition, how the M&A acquisition is structured, which then leads you to a right of use asset which needs to be adjusted for market terms if appropriate on acquisition. And that is the real key that you need to do. If you've got material leases in the business being acquired, don't make the assumption that whatever the acquiree has done in their books is the same number that must be used for the business combination accounting. There are some intricacies there. I think I'll leave leasing alone now and move on to the next one, which actually is far more exciting for me. This one has real double counting implications from a purchase price allocation point of view. And when I thought about it last night, I actually thought the best way to do this was actually put together an example. Now, this example is also from the accounting news articles that BDO has on its website and in the monthly accounting news. And it's very simply, it's a bit of an extreme example, but it shows the concept. So I like this because it shows the concept that we're trying to get across. So in this case, entity Y acquires entity Z. So that's a business combination where entity Y is acquiring the business of entity Z. So it's a holding company, a subsidiary company relationship. Entity Y will obviously then account for the business combination at acquisition date. And I guess at that point, they'd consolidate it forward as part of the group. So entity Z has a contract to develop a website for a customer in the scope of IFRS 15. So that's the revenue standard. And the revenue is based, and revenue is also based on the number of website visits over the next 5 years. Now, in the software and the IT world, these are quite common actually, where you actually have a customer relationship where, to a degree, all the performance obligations are already delivered at the start, and then it's essentially just collecting the revenue over the period of the arrangement. So like a subscription type collection. And what ends up happening here is that the entity Z in this case, they've already recognized the revenue for the performance obligations. They've delivered all the performance obligations, but the revenue might be based on the next 5 years based on, let's say, the number of site visits. That doesn't actually influence delivery of a service. The service has already been delivered. The website has already been created. But what they are doing is they're essentially earning variable revenue consideration. It's essentially a usage-based revenue charge. And that's what that variable charge is essentially constrained. We don't recognize the revenue on the constrained amount, on the variable amount, until the variable amount is, or the uncertainty is removed. And really what happens here is it's almost like a royalty or even a trail that's coming into entity Z. So if you really peel this back, entity Z is essentially recognizing a trail of revenue after they've done the website development. The trail of cash flows will come based on website visits. So if entity Y acquires entity Z, they're not actually acquiring a revenue contract, they're acquiring a trail of cash flows, a right to receive cash flows going forward. And that's the complication already you can see in the business combination. So if we head to the next slide, Aletta, if you may, as the cash, oh no, sorry, one back. Yeah, I was waiting for the red block to come up. As the cash flows do not require entity Y to provide any goods or services, entity Y as the acquirer, from their perspective, it's a financial asset, not a contract with a customer under IFRS 15. And this is where I'll go to the interlocking slides on the next one. I find this quite useful because in terms of the subsidiary, in this case, they are in IFRS 15 or IFRS 15 because they are accounting for the cash flows from the website development as a revenue contract. But when IFRS 9 is applied from the acquirer's point of view, because they are acquiring on acquisition a financial instrument, a trail of cash flows. The revenue has already been, or the contract that gave rise to the revenue doesn't exist from the acquirer's point of view. They've just acquired a stream of cash flows based on the customer's usage later on. So that's what I mean by interlocking standards, is that on acquisition, the acquirer essentially is in a different standard on the wheel than the acquiree is. Okay, so from their point of view, from the acquisition or the business combination point of view, entity Y, sorry, Aletta, you've jumped. Yeah, there we go. From entity Y's point of view, they've acquired a financial asset. So the question here is, what have they acquired? Have they acquired essentially a trail? And it is. And how do they classify that on acquisition? And in this case, they've essentially acquired an instrument which is not made up of principal and interest solely. It's an other type of financial asset, which means it's a fair value through profit and loss instrument. So on acquisition in the business combination, entity Y will, as part of the business combination, record a financial asset at fair value through profit and loss. Essentially, the trail of cash flows that are going to come from that underlying customer must be fair valued on acquisition as a financial instrument. Okay. So if we move then on to the next one, this is then a summary of that example. From the acquirer or entity Y's point of view, they have a financial asset which varies based on web traffic. At acquisition, they would recognize a fair value through profit and loss instrument. And if you compare that to what the subsidiary is doing, what entity Z is doing, they probably don't have an asset recognized yet, or if they have collected money in advance, they would have had a deferred income amount sitting as a liability. Essentially, the subsidiary and the holding company in this case would have completely different accounting for this particular contract. And then subsequent accounting is that the acquiree or entity Z, they would recognize revenue as the web traffic happens and they actually collect money based on the web traffic movement, whereas the entity Y on consolidation, they would have a financial asset that would be valued at fair value through profit and loss every reporting date, and they would not be reporting those amounts collected in revenue that entity Z is accounting through revenue. So you can see there's a complexity here that absolutely befuddles the mind, and especially if your revenue contracts in the subsidiary are multi-year contracts for, let's say, software or any type of arrangement where it isn't really unit-based. So there are these multi-year revenue contracts. At acquisition, counting under the business combination can give you an interesting outcome for the initial and ongoing acquisition of the business combination. So we should be aware of that going into this. Now, I am going to wrap it up relatively soon because I do want to give some time to Aletta, but the double counting concept is one that I think is really important. And I'm going to base this on the previous example of entity Y and entity Z. Very often in a business combination, customer relationships will get customer relationships will be one of the intangibles that is recognized in the business combination. And a customer relationship is often valued normally on a relief of royalty basis. So what you're really doing is you're essentially looking at future cash flows to work out the value of the relationship. Sorry, actually the relief of royalty is actually a brand valuation. The customer relationships is more discounted cash flow calculation. Forgive me for confusing those. So we go back to the customer relationships. It's a discounted cash flow type model where you're essentially working out the perceived value of your customer relationships at fair value on acquisition. But in the previous example, I now have a fair value financial asset on my balance sheet, which represents the stream coming from my entity Z customer relationship. This is an example of a trap you can fall into about double counting. Because in measuring your customer relationship asset, let's say on a discounted cash flow basis, you could inadvertently include in that the entity Z cash flow trail. But then by recognizing the entity Z cash flow trail as a separate instrument, you will have double counted the assets on your business combination. This has come up quite a few times in the last 3 or 4 months in some mergers and acquisition arrangements we've seen. And it can have an enormous impact if there are large multi-year type customer relationships that are giving rise to both a financial asset and both a customer relationship asset on acquisition. So that's a real point to ponder when you're doing your acquisition. Now, I did promise Aletta that I'd be done in the first 30 minutes, and so I'm basically there. So the last ones I'll just point out are actual financial assets under IFRS 9. And this is essentially if the acquirer is acquiring, debtors and investments in shares that are on the balance sheet of the acquiree. And just remember that once again, financial assets acquired in a business combination are initially recognized at the time of the business combination at fair value. That's the concept. So if we run back to this slide, which is financial assets, those assets that are acquired, especially the amortized cost assets, so those will be your things like debtors and loans receivables. they will be based on an amortized cost method in the books of the business being acquired in the acquiree. But you would need to fair value those assets on acquisition of the business combination. Once again, giving you a difference between the subsidiary accounting and the holding company accounting from that day forward. And we often see this with things like expected credit loss, which I think is my final slide or my penultimate slide. So the impairment of financial instruments or financial assets, it follows a staged approach where you essentially work out the expected credit loss based on stages 1, 2, and 3. When a business combination occurs, the entity acquiring the acquiree, they don't acquire an asset and a provision or an impairment adjustment. They acquire one instrument, which is the financial asset at fair value. And the fair value of an instrument at acquisition isn't necessarily equal to the subsidiary's gross amount minus its impairment or provision allowance. Because of things like changes in market and discount rates and interest rates, the impairment loss recorded by the acquiree before acquisition may not be indicative of the fair value of the debtor acquired on acquisition. So just another complexity to worry about. So in my last slide then, I basically summarize that and I say, things to think about is when you are acquiring financial assets in the acquiree, there is this tendency to assume that the purchase price allocation, the subsidiary amounts or the acquiree amounts are already at fair value for financial instruments, but that may not be true. And especially in a post-COVID-19 world, or where the receivables or the financial assets are longer term in nature, I think you're going to find more and more that the fair value of those instruments in an acquisition is probably not indicative of the fair value or the book value recorded by the subsidiary. Aletta, I'll leave it at that and hand that back to you. I think I'm keen to hear the rent concession session myself. So thank you very much.
Thank you very much, Kevin. First of all, I really appreciate that Kevin has taken the time to really develop part A of this presentation and to cram it into 30 minutes. Originally, we were going to do it in an hour. And that's allowed me to really focus on the COVID-19 related rent concession, which is really a hot potato at the moment. So thank you for that, Kevin. And I think the other reminder is, over the last number of months in our accounting news, we've included, I think, 3 articles focusing on business combinations and the impact of the triple threat accounting standards on business combinations. So if you want further explanations, please feel free to have a look at that. But otherwise, please contact us, happy to help. So Kevin, thank you very much on a time perspective for helping me and also for doing that so efficiently this morning. So if we look at COVID-19 related rent concessions, I thought I'll just start by the real basics. So we now have IFRS 16, and for all our leases, you know, our day one journals is we bring on our balance sheet a right of use asset and a lease liability. And that right of use asset after that would then be depreciated as we use the right of use asset. And as we make our lease payments, a portion of the lease payment would be an interest expense on that lease liability, and a portion, according to an amortization table, would be a capital repayment on our lease liability. Now, the other thing that's happened, and I've talked about this diagram a lot, and Kevin, you who know it well, will see I've added another red block on the right-hand side with termination of leases, because we've tried to capture, especially for our clients, you know, IFRS 16 has a lot of requirements on what you have to do on an ongoing basis. It's not a set and forget standard. And, you know, there could be new leases, there could be reassessments, various types. There could be modifications where there's formally agreed new terms and conditions between lessors and lessees. And there could be terminations of leases. And important that terminations of leases are not normal expiries of leases. It's really we've decided to terminate a lease early. Now, when we've worked on that, we've seen an interesting thing. There's different rules around when we update incremental borrowing rate, different rules on whether we expect profit and loss impacts. So at a very high level, you know, your new leases, it's the journals on the previous slide. Reassessments, you can see, irrespective of whether you've got a new discount rate or not for the different parts, the one thing in common on reassessments is there's no impact on P&L. And the reason for that is whatever you adjust your lease liability with, you have a similar adjustment to your right of use asset. And then when we get to modifications, that's always been the complex one. You know, for two of the three types of modifications the standard address, again, complex rules. However, you know, the change in the lease liability for two of the three of them also have a corresponding change in the right of use asset. The one that I've marked in red, the bright red, says, listen, it's a two-step approach, and very important, there's a potential profit and loss impact, and that's why we've always had it in red. And then the other thing is terminations of leases. You know, there's a potential P&L impact. So those two red ones are always the ones that we said, guys, look out for them, because it's not just adjust the liability and also adjust the asset, it's actually a P&L impact. Now, little did we know when we put this diagram together and tweaked it over the last year or two that COVID-19 will happen, and these red blocks will become quite prominent, and we'll see it quite a lot. And also, little did we know that the International Accounting Standard Board will actually change IFRS 16 and change what's on this diagram to make a very special rule for COVID-19 type amendments. So what I'm trying to do today is illustrate and flag with you that there are different options available for you when you think about rent concessions. The one option is to look at what's on this slide. And the other option is to look at the practical expedient based on this change put through by the ISB a few weeks ago. And then we're helping clients to model it so you can think which is the best for your circumstances. Whether you use this diagram with all its complexity, or whether you use the practical expedient that I'll explain very soon, you know, it's a difficult thing. It's so interesting, Kevin, listening to you this morning, because IFRS 16 is a contract-based standard. You know, it's very important that you agree and put into place amendments to contracts and formally document the arrangements between lessors and lessees, because unless it is agreed, unless we have a contract, you know, the accounting is really, you know, you can't account for it. We're looking for a contract. It's a contract-based standard. So a lot of similarities in that perspective. So that's part of the introduction, the current state. So if we look at the impact of COVID-19 on leases, we've seen that landlords may offer concessions to tenants, and it could be that there's a rent-free period during COVID-19. There could be deferral of payments. What we often see in Australia is a combination of the first two, because the code that's been promoted by governments in the various states say, you know, we are recommending that you negotiate, and we are recommending that you think about maybe a 50% rent waiver, and maybe the other 50%, let's have a deferral of that. But, you know, it still has to be formally agreed by lessors and lessees. That's just a recommendation. And we've also seen situations where there are certain cash payments being made by lessors to lessees to compensate them for disruptions to operations, especially around shopping centres. So the second big bullet point here, the second triangle, you have to determine how to account for such, or, you know, when we consider how to account for these concessions, it will very much depend on what I've got in blue, the precise terms of the lease contract and the nature of the concessions. So there's really not a one-fit accounting solution to everything. So what exactly have you, as a lessee, agreed with your lessor? By the way, today I'm just talking about lessees. There's a whole raft of different issues for lessors, which we'll include in future webinars. It's just about lessees, which I think is the big issue. So there's another question also in the background, you know, if we receive these incentives and if these incentives are actually provided by government, you know, is it within the scope of IAS 20? To be honest, in Australia, I haven't seen many of these rent concessions necessarily provided by government. It's negotiated by lessors and lessees. So what we've done after the IASB issued the amendments to IFRS 16 at the end of May, we've put out a bulletin, and there's a link to that bulletin where we explain how that amendment worked. And in that document, we've included a diagram which steps through the amendment, and it really says there's 4 criteria that you have to meet in order to be within the scope of the amendment. And if you are within the scope of the amendment, you still have a choice whether you want to apply this amendment or not. And we've talked about this in last month's webinar as well. So I don't want to focus on this. It's just the point, you have to make sure you're in the scope of the amendment. That's the first step. So whether your actually agreed concession is within the scope of the amendment, and if you're in the scope of the amendment, you know, do you want to apply it or not? So currently I'm working with a large number of clients where we're modeling for them. If you don't, you know, number one, you're in the scope. If you're in the scope, what would the numbers look like if you apply the practical experience, and also what would the numbers look like if you don't apply the practical experience, and then they decide, because it's a choice. So what I'm trying to illustrate now with some very, very simple examples today is very high level. If you do not apply the expedient, what do we expect to see in your financials? As opposed to at a high level, if you apply the expedient, you know, what do we expect to see? So you can get a feel for what are the potential benefits of applying the expedient versus not applying it. So important, before we had this new practical expedient, or if you decide not to apply this practical expedient, what will you have to do? Now, you'll have to assess whether your COVID-19 rent concessions is a modification in terms of IFRS 16. So as part of that consideration, you'll have to consider whether your lease agreement includes a force majeure clause or not. And if there is a force majeure clause, whether the force majeure clause covers a pandemic like COVID-19. Maybe a bit of information about a force majeure clause, and I should start off by saying I'm not a lawyer and I cannot give legal advice. This is just background information around force majeure. If you want to go down this path, I would advise you to get legal opinion on whether your agreement has a force majeure clause, and in particular whether that force majeure clause would cover a pandemic. A force majeure clause usually seeks to deal with the impact of contracts, the impact on contracts of events which are out of the control for the contracting party. So it would govern relief that is available when a party is not able to perform their obligations. Now, to successfully invoke a force majeure clause, performance of the contract must be impossible. So it's not enough, or my understanding is it's not enough that the performance may become inconvenient or too costly. It must actually be impossible. So contracts that include force majeure clauses often define events that would trigger the clause. And, you know, as a general rule, force majeure clauses will not be implied into contracts. So just a few things to think about, and you can see why you have to speak to your lawyer about this. It's not my field of expertise, just setting the scene. And then in blue, I just want to come back again to the point. The starting point, if you want to go down this route and not consider the practical expedient, or if this practical expedient maybe is not available to you because you're not fitting within the scope of the expedient, in blue, the starting point is to examine the terms of your contracts, contract-based agreements. So because we have to figure out whether your contract, as a result of these changes in the COVID-19 payments, whether we've got a modification or not, because the standard has specific rules on how to account for modifications. So if I put it in a bit of a decision tree, I said the first thing, does the leasing agreement include a force majeure clause? If I say no, then I have to deal with it as a modification, complex rules. If it does have a force majeure clause, I have to consider whether it covers a pandemic. And if I say no, it doesn't, then I've got a modification here. And if it does, I've got a reassessment. So this is all the original IFRS 16. So if we put it and overlay it to a very simple example, and let's say we've got a lease that started very conveniently on the 1st of July last year. So it's on the date of initial implementation of IFRS 16. We're only paying $100 per month, and we're paying that for 20 years. Now, on 1 April 2020, the lessor and the lessee agrees. So this has already been agreed. They agree on a six-month rent concession, and it's 100% waiver for the period 1 April to 30 September 2020. Now, if you're not within the scope of a practical expedient, or you don't want to apply it, what will you have to do? So on 1 April, the lessee needs to assess the lease agreement. And they, in this instance, in my example, they've assessed it and they've determined there's no force majeure clause, and therefore we've got a modification under IFRS 16. The second thing is they will then have to recalculate the lease liability on the new remaining payments, and those remaining payments will now be less because for 6 months it will be zero. And they'll have to recalculate that lease liability using a new incremental borrowing rate. So whatever incremental borrowing rate you used on 1 July or the start of the lease, no longer appropriate. What would a new incremental borrowing rate be today? And that is a process. Due to all the things that's happened, it would be very different. So it's new payments, new incremental borrowing rate. You'll have a new lease liability. And when you have that new lease liability on the 1st of April, you'll also now have to do a new amortization table for the remainder of this lease. And when on the 1st of April, you compare your old lease liability and this new lease liability that we've just worked out, your journal would be debit your lease liability and credit your right of use asset as required by the original IFRS 16, with the difference between those two amounts. And the effect of this is, because you are also adjusting your right of use asset, it means your depreciation on that right of use asset for the remainder, the rest of the 19 years, will be based on a lower right of use asset. We will reduce our depreciation. So if we stand back at a high level, technically, we've got a lease modification under IFRS 16 and the resulting complex accounting. And remember, technically, you had to look at all of your agreements and consider whether it's force majeure and all those things. Commercially, though, is what I want to highlight. The gain as a result of this rent concession is actually spread over the next 19 years. So you've got the 6-month waiver, You have the cash flow savings, so that's good because cash is king. However, the accounting gain will be spread over the remaining 19 years. All right, so one of my clients actually said, you know, we would prefer this because we've put our budgets in and, you know, it's not a big change to our numbers and they want to spread it. However, most of my clients are saying, listen, when we prepare 30 June 2020 financials, we want this gain and this is not nice. You know, we get a cash flow benefit, but the gain is going over 19 years. You know, so that is a shortcoming of this approach potentially. So let's contrast that directly with a scenario where we take exactly the same fact pattern, but we, on the 1st of April, assess whether we meet the criteria to apply the practical expedient. And, you know, when the lessee looks at it, they say, listen, we're in the scope of the practical expedient. And so they meet the criteria. And what the lessee now has to do in terms of the practical expedient is to recalculate the lease liability based on the new lease payments agreed with the lessor, and as some relief or assistance, the lessee will base that recalculation of the lease liability on the original incremental borrowing rate. So you don't need to go through all the pain of updating incremental borrowing rate for each individual lease. Whatever you used at the start, you continue with that, right? So that's a big relief. So you still have to make sure you fit within the practical expedient and the scope, but you can use the original incremental borrowing rate. The other relief you're getting here is you don't have to go back to all your leases and see if there's a force majeure clause and see whether the force majeure clause covers COVID-19, or, you know, you don't have to do all of that. All you have to do is make sure you meet the criteria to be eligible for the practical expedient. That's what you have to do. And you don't have to update your incremental borrowing rate. You use the original one. However, you do have to redo your calculation of the lease liability. And again, you'll have to also then obviously update the resulting amortization table. And the journal you process, again, is the difference between the old lease liability and the new lease liability. And the difference will be debit lease liability. And instead of, as we had in the previous example, credit right of use asset, you credit gain in your profit and loss immediately. So therefore, this journal doesn't change the right of use asset. It doesn't change depreciation. You continue with depreciation as you've always done. So technically, if we stand back, we would say, okay, I don't have to do the complicated assessment. I don't have to update my incremental borrowing rate. And the third thing, I get the hit to my P&L immediately. So, and it relates to the whole 6 months of cash saving, you know, the hit goes into P&L immediately. So technically, you know, it's a real special rule that's written particularly for COVID-19, trying to make it easier. And commercially, as a result of this rent concession, we now get the recognition in our profit and loss as soon as it's agreed with the lessor. If you look at this example, there's been a lot of debate on, you know, the need to update the lease liability, recalculate the lease liability, update the amortization table, etc. And you know, where it's actually fallen is there's no way you can avoid recalculating your lease liability and redoing your amortization table, because these things, you know, the implied interest expense, and time value of money, all of those things will have an impact on your lease liability and will have an impact on your remaining amortization table. But to get to a bit of assistance is, okay, at least you don't have to update your incremental borrowing rate, and commercially you can book it in P&L. And you don't have to look at all your agreements, you just make sure you fit into the expedient. Now, I want to throw in another example that is based on discussions I'm currently having with our advisory clients. And remember at BDO, because we have BDO Lead, our software as a service that many large entities use, and because we do outsourcing of lease accounting for so many clients across Australia and New Zealand, you know, we have a lot of discussions with clients around this. So it's like really hot. So one of the things clients are telling me, and it's in particularly important in Australia because we've got a 30 June year incoming, clients are saying, Aletta, practically this is a complete nightmare disaster to get all these rent concessions agreed with our landlords. You know, we've got 7,000 leases. You can imagine with, let's say, 7,000 different landlords, to agree all of this and sign on the dotted line, because I've been telling all of them, if you want to book the P&L for 30 June 2020 financials, you need the landlord and you to agree and sign. I need a contract, as Kevin has said, it's contract based. And they're saying practically this is killing us. And I'm saying, okay, so, you know, what are you doing at the moment? And I said, you know, we've just unilaterally decided, some of them are saying, and I hear this very regularly, that in April, May, and June, for example, we've just decided whether the landlord has agreed to it or not. We've just decided to ensure our survival that we're going to pay 50% of the normal lease payments. So this example is looking at a situation where this rent concession has not been agreed yet. Therefore, all the things we've talked about to now hasn't kicked in yet. So how do we deal with that? So in my simple example, I've said the lessee decides unilaterally to pay only 50% of the payments for 3 months. Normally, monthly lease payments are $100. And in this thing, and this is to make it real life, clients, this client processes their monthly lease payments through the creditor system with a debit to operating lease expense. So that they continue to do what they've always done, and runs through the creditor system. And then at the end of the month, the finance team uses BDO Lead, for example, or a technology solution, and they come over the top and they remove this operating lease expense and they replace it with the correct numbers under IFRS 16. Now, just to keep it simple, I haven't done an amortization table or anything. I've just put in numbers to illustrate the point. Assumed monthly depreciation is $20 and assume our interest expense, according to our original amortization table, is $12, $10, and $8 for April, May, and June, respectively. And so the lease agreement does not include any penalties or additional interest on late payments. So if you know, traditionally, if you pay 10 days late, etc., there's no penalties or late payments, and let's keep that in. And then on the 1st of July, finally, after year end, Entity A and the lessor finally formally agree on this 50% rent concession for April to June. Now, that doesn't help us. That is a non-adjusting subsequent event. So, you know, at 30 June, what are we going to do here? And then assume that Entity A qualifies for this new practical expedient, and they've also elected to apply this new practical expedient, and their reporting date is 30 June. So it's not been agreed. So if we look at the journals, that first journal is the journal that the creditor system creates. Say we credit cash and we debit operating lease expense. I mean, that's what we, you know, our system generates. And now the bottom two journals is what the finance team come and they over the top and they fix that that first journal. So depreciation is easy. They have their depreciation expense $20. And then they say, okay, we will now say we credit that operating lease expense with only 50. Remember, our system will give us information, And our system will tell us, based on the contract information in our system, that that credit operating lease expense should be 100 because that's what we were supposed to pay. Now, if you process that information, credit operating lease expense 100, and you say debit interest expense 12 and debit lease liability, the balancing figure of 88, and that's the information out of your system, what will happen is you are inadvertently booking a gain to your P&L. And you can't do that because, hang on, number one, you cannot reduce your lease liability if you haven't made a payment. Legally, you still owe that money. You haven't agreed it with the lessor yet. So that won't be right. And you can't say credit operating lease expense of 100. You were supposed to make a payment of 100, but you haven't. You only made a payment of 50. And therefore, what I'm proposing here is that we would say, listen, the interest expense is the interest expense from our original amortization table. The lease liability is only reduced with 38. Sorry, and that should be, that capital redemption should be 88 from the original capital redemption, and then less 50 to get to the 38, because the actual redemption is just 38, and our operating lease cash flow should be the 50. It can't be the 100 from the amortization table because I've actually only paid 50. And then if you go to May, I do a similar thing. So here I'm saying, listen, that operating lease expense, it's only 50, I've only paid 50. And my lease liability should be, yes, I had a redemption of 90 in the amortization table, but my cash flow was different, so I can only reduce my liability by 40. And in June, I'll do a similar thing and say, hang on, my original redemption was 92, but that's not what's happened because I haven't paid. I legally still owe them, so it should only be 42. But what's very important here is you can see in these 3 sets of journals for April, May, and June, I'm continuing to work with my original amortization table. So I haven't recalculated the lease liability, and I haven't redone the interest expense. I haven't done any of that. And the theoretical reason for that is I haven't agreed anything with the lessor yet. And IFRS 16 doesn't allow us to make changes at random, recalculate lease liabilities and amortization tables. So it's just not a thing we do randomly. And, nowhere in IFRS 16 is it saying if you make a payment late, update the amortization table, or if you miss a payment, update the amortization table, and that will just become a nightmare. And by the way, you cannot reduce your lease liability because you've got a legal obligation to still pay that lease liability. And to round out the conversation, when you finally on 1 July agree this concession, basically retrospectively with the lessor, yes, then your lease liability, 150 of your lease liability have been waived, and you credit that gain in P&L immediately 150. At this stage, you'll redo your amortization table, etc., and you'll just look at future lease payments, and that would have been what you previously had, because the rent concession just relates to concessions before this date. And I've put there a point 3 in red, and that is, some people have been talking about an alternative approach to, recast amortization table and lease liability already in April, May, and June, to adjust that implied interest expense, earlier. But this just becomes an ongoing nightmare if we start to do that, because, what really triggers that? And currently, before we had COVID-19, before we had this practical expedient, that's not what's been happening, even if people might have been paying 2 weeks late or missed a payment and then caught up again. We were just rolling with the original amortization table. the key point why I've put this example in, although there's, as you can see by this red comment, I suppose I know there's an alternative approach out there that personally I don't agree with. I've put it out there because I wanted to put it on your radar that, you know, you cannot just push ahead if you've not got agreement with a lessor. From an accounting perspective, it creates complication. But I understand from my clients practically to do this is really, really difficult. So I thought let's wrap it up with next steps. Now, step one, if at all possible, please agree your rent concessions with your landlord and your lessor. You know, if you would like to book the rent concessions as a gain in your 30 June P&L, you know, we have to lock it in before 30 June 2020. And then after you've locked it in, we have to carefully consider the terms of these rent concessions, you know, because we want to know whether rent concessions are within the scope of the practical expedient or not. And then, you know, I'm saying to many clients, let's model the alternatives. If you don't want to just go for the practical expedient, take the gain. If you want to model the alternatives, we've got the ability to model it for you. If we apply the practical expedient or doing it the normal way, as in spreading it over the remaining period of the lease. And then, you know, decide finally whether you want to apply this expedient or not. In a way, this whole process reminds me about all the conversations we've had about there are 3 transitional methods to IFRS 16. Always better to model all 3 and then pick the most appropriate. I mean, you've got this free choice. Free choice doesn't come very often in accounting. So again, the situation here. Before we move on and wrap it up, I wanted to say, please stay in contact with us. And please watch out LinkedIn posts that we put out, accounting news, our webinars. This area is evolving, not just rent concession, everything around COVID-19 is evolving. The accounting treatment similar to the medical stats. Every day there's something new. Please stay close to us. That's what I'm trying to say. We are trying to stay close to you. But it's much easier if you also try and stay close to us so we can keep you informed. If you need assistance, obviously we've got assistance around lease accounting, the different models. We've got free resources that you can log into to stay close to us. Obviously LinkedIn is a good way to do it. If you want to speak to one of our IFRS advisory partners, their contact details are here. If you want to reach out, please do so. And otherwise, Kevin, I think that's it from me as well. Any final comments from you?
No, I think that's a good summary, Aletta, and I think watch this space.
Absolutely, watch this space. Kevin, as always, thank you very much for your time and contributing and doing these wonderful webinars with me. It's great fun. And to all our clients, thank you for joining us. And we hope you have a great day. And from my home to wherever you are at work or at your home, stay safe and stay sensible.